A very good afternoon once again, ladies and gentlemen. I'm Jonathan from Crow Singapore, and welcome to our Transfer Pricing webinar. Our presenter this afternoon, Dr. Soumya Varadarajan, will be providing us with insight into how the Inland Revenue Authority of Singapore's transfer pricing guidance interplays with that of the OECD's very own recently published guidelines against the backdrop of the COVID-19 pandemic. The presentation for today's session is also available in the right-hand column of your screen in the tab Handouts. Also, you may submit your questions for our presenter at any time during the session in the tab Q&A. Dr. Soumya will endeavor to answer your questions at our Q&A segment towards the end of today's session. So before we begin this afternoon's webinar, I'd like to share with you about our firm, Crow Singapore, as well as our international network, Crow Global. Crow Singapore belongs to Crow Global, the 8th largest professional services network in the world, with over 200 independent accounting and advisory firms with a presence in more than 140 countries. Crow is also ranked the 6th largest in the Asia-Pacific region. Crow is among the top 10 professional services firms in Singapore, led by 25 partners and directors with over 100 experienced professional staff. Crow Singapore has also presented the Growth Award in the Open category in 2018, as well as the Best Practice Award in the Large Practice category in 2016 by the Institute of Singapore Chartered Accountants, or ISCA. We have over 10 professional service offerings in accounting, including audit, tax, business advisory, transfer pricing, fund administration, and digital advisory, among others. Our presenter for this afternoon, Dr. Soumya, is our Director for Transfer Pricing Services and has more than 15 years of experience in designing, documenting, and defending intercompany transactions. She's also published numerous articles on transfer pricing topics in regional newspapers such as the Business Times, and is also the author of Transfer Pricing in Singapore, published by Walters Kluwer. Dr. Soumya is also a frequent presenter at conferences organized by the Singapore Accountancy Academy, ISCA, and CCH in Malaysia, Singapore, and Hong Kong. Ladies and gentlemen, your presenter for this afternoon, Dr. Soumya.
Glitch there. Thank you, Jonathan, for the introduction, and good afternoon, everybody, and it's good to be connecting with you once again. It would have been good to actually be able to see you all in person. You all can see me, but unfortunately, I don't have the privilege of it in reverse. But I hope that today we can have a very good discussion on the transfer pricing guidance that's been provided by IRAS, as well as, and see how it plays up with the OECD as well. Now, as most of you are aware, the IRAS came up with its transfer pricing guidance back in September, whereas the OECD just came up with its guidance in late December. As a matter of fact, it was 18th of December, just before the Christmas holidays. And the view was that the OECD was hoping to provide the necessary guidance with respect to helping companies, set their transfer prices or complete the transfer pricing adjustments that they needed to do before the financial year end was concluded. Now, we were planning to organize this seminar today. We've been working on it for the past month, and I put all of my slides together, and lo and behold, on Friday, after I've done all my work, IRAS comes up with additional guidance as well. So this is really, really hot off the press as far as we are concerned. And it's good that we're doing this remote. If you were coming in person, we would have to incur additional cost, to reprint all of these slides, which would have already gone for printing by the weekend. So, there is silver lining in all of this, and that's something that we will come back to again, right? When we talk about the financial statements, do the costs that are being booked, are they reflective of the times we are in? Are they adjustments? Are they substitute to other costs and things like that? So with that high-level introduction, let's take a look at, what the pandemic is and how we've been traveling through it, just as an introduction to the whole COVID-19 issue, right? All of this, I think it's just, it's more introductory more than anything. A lot of us were thinking, going back to, I guess, February of last year when COVID really started happening in Singapore. We thought that it was going to be a 6-month affair, a 3-month affair. People were still hoping to go on, school holiday, June time overseas and things like that. When we started to see the difficulties that we were facing and what was actually happening, I think we still were hoping that we would go on our holidays in December, and now that's also been curtailed. And lately, about 2 weeks ago, you heard that Lawrence Wong was saying, this might be there for nearly 4 to 5 years. Travel might be quite stunted. There is going to be, new waves of possibly lockdown restrictions and so on and so forth. And, at the beginning of January, this is what we were seeing. European countries went into fresh lockdowns. Malaysia, Malaysia more than I do. They're in a state of emergency as well as extended lockdowns and the equivalent of our circuit breakers. So I think overall this situation is going to be there for a while, and that is something that we will also need to discuss when we go through our transfer pricing analysis, right? Because are we going to treat a lot of these changes as one-off and try and make the necessary adjustments for them? Or are we going to assume that this is something that's more long-term? OECD alludes to it. IRAS does not necessarily talk about it, but I think that's something that we need to think about. Is this the new normal? Is this our way of life for the next 4 to 5 years, right? Which means that it's not going to be considered a one-off event, but this is status quo, right? Let's now look at, these are just the countries under lockdown as of January 2021. It's just statistics. If you look at the growth rates reflective of 2019, you can see what the growth rates were for 2019. You can see what the growth rates have realized for 2020. Obviously, pretty much every country that we've looked at least from the Asia Pacific region, they're all in negative growth. And then for 2021, it seems like we are expecting positive growth again. But just keep in mind that comes from a very low base. We're taking the 2021 changes off 2020, where 2020 is at it's been a significant negative growth rate. Having said that, the talk of the vaccines, the fact that there could be a potential for travel sometime soon, things like that are, hoping to boost the economy again. At the same time, we're also seeing that there's a lot of mutation with respect to the virus, and we're not sure whether these vaccines are really going to be as effective. I mean, the effectiveness ratio goes from 95% to 8%. I'm sure you all saw that Germany said that, either it's AstraZeneca or Pfizer or one of them, it's only 8% effective, which means that you don't even need to take the vaccine, right? So I think there's a lot that we're going to be looking out for. And as of now, we are hoping that it's all going to be growth, but, every bank and the World Bank, the IMF, they've all cautioned us that the GDP levels for the countries are never going to go back to what it was for 2019 for 2021. Yes, it's going to be a growth compared to where we were for 2020, but it's not going to be at the 2019 level yet, right? So that's something that we need to keep in mind. Now, linking it back to transfer pricing, I think some of you who may have come to our seminar last year on COVID-19 would be familiar with the next 4 slides, which is where we were talking about the specific intercompany transactions and how, what are some of the considerations that taxpayers need to keep in mind when they are entering into these transactions. And I think let's go through this as a backdrop. And then when we talk about the OECD and the IRAS guidelines, we will make references back to this, right? So the first example is a very simple management fee transaction where you have a regional headquarters that is charging out management fees to various service recipients, and the transfer pricing policy is one based on cost plus. IRAS has come up with guidance on both tax residency as well as clarification of PE. So if under the Singapore Income Tax Act, so if you were for some unknown reason, it's a foreign related party that is providing services to the Singapore taxpayer, and it turns out that that person is actually physically sitting in Singapore, then they're under certain conditions, IRAS will take a view that that does not necessarily constitute a PE for the foreign related party, right? So that's on the corporate tax side of it. But what are some of the issues that we are seeing from a transfer pricing perspective? I think the big one is definitely going to be around the substance and the benefits issue, right? So let's assume that you are you're providing services, and the services require you to go in country to provide those services. So for example, quality testing, environmental health, quality, and safety checks, right? So the service level agreement between the related parties has been signed such that your EHS manager will visit the countries on a monthly basis for a day, whereby he will undertake a bunch of tests, or he will review your processes, he will inspect machines, he will inspect how you're doing your operations, and then he comes back to Singapore, he produces a write-up, and he gives you guidance and advice on how you should be improving the way in which you're operating. Right now, that entire process would not be able to take place due to the travel restrictions that are there. Does that necessarily mean that the regional headquarters should not be recharging its costs associated with that service to its related parties? Now, the next question would also be, if the regional headquarters is not going to be charging the related party, what happens to those costs, right? Because they have been incurred with the expectation that these services are going to be performed. The other issue is also that, can he provide those services remote? And if he provides those services remote, is there really that level of benefit that is derived by the service recipients? Or by him doing these services remote, do the service recipients start taking on those services themselves and improving their capabilities to do these checks on their own, right? So these are all the questions that we will actually need to look at from a very, very simple, cost plus arrangement with respect to regional management services. Now, the big question is, should the cost plus arrangement still stay? Is the markup still the markup that you had agreed upon previously? And what actually goes into the cost base, right? So in relation to that, previously, remember that, there was a lot of travel. Now, obviously, for 2020, the travel budgets, so the travel costs have gone to next to zero, right? So is that being replaced by other costs, such as, infrastructure costs, IT infrastructure costs, better work from home management, costs associated with Zoom, costs associated with making, employees work from home initiatives more comfortable? Is it just a replacement of the cost base? What else is in there? And that's really what we need to be thinking about in order to justify that the transaction is okay, right? Some of you may end up taking the view that I will just proceed as per normal, which is fine. But some of you may want to make some changes to it. So the key question is, how are you going to be able to make those changes? Okay, now let's move on to the next set of transactions. Again, this is a very, very common set of transactions. Here you've got a company that is manufacturing products. He then sells it to the distributor. You determine your transfer price based on something. It could be based on fixed costs. It could be based on market minus. It could be based on giving the distributor a guaranteed return. And essentially, you will have undertaken a function, asset, and risk profile for both the manufacturer and the distributor. So you could either have a situation where the manufacturer is considered to be under a contract manufacturing arrangement, right? So distributor is essentially the principal, or alternatively, the manufacturer is a full risk manufacturer who then sells it to the distributor, who is somewhat like a limited risk distributor, right? And the key question is, as a result of the issues that took place because of COVID-19, how are some of these functions and assets and risks, how are they changing to reflect the COVID-19 situation, right? So for example, manufacturers located in China, distributors located in Singapore. When you were, at the start of the COVID-19 situation back in February or March, obviously there were no products that were being able to leave China into Singapore, right? So if the original transfer pricing analysis back in 2019 was done that China is a contract manufacturer, and as soon as it manufactures the products, it will ship them off to the distributor. Now, then there is going to be a change in the functional profile, right? Now, the Chinese manufacturer is also going to have to take care of finished goods inventory, right? And therefore, his risk also will tend to change. Does this result in a change in the transfer pricing policy, right? Similarly, from a distributor perspective, maybe the conditions of it was that the distributor will place an order with the manufacturer, and the distributor is expected to honor his purchase quantities and volumes, right? And that's how many of you might deal with your third parties, right? So third party places an order on you, it is considered to be a confirmed order. Now, if that is the case, if you as a manufacturer had surplus, you already went ahead and manufactured these products, but the third party is not able to take those products from you, will you be charging them, will you be trying to offload these products to your third party? Yes. So similarly, are you going to try and do the same with respect to your distributor, right? So I think these are some of the questions that you will have to look into. And, that's again where the guidance from the OECD as well as IRAS kind of comes about, right? We'll go through the exact guidance later on, but these are some of the things that they are starting to think about. Okay, let's move on to the third category of transaction. If many of you who might have heard me in previous sessions will know, the transfer pricing is divided into 4 buckets of transactions, right? So you've got the trade transactions, which is what we just looked at. You have the services transactions, which is what we looked at as the first case study. The third case study that we're going to be looking at is really looking at valuations, right? Now, it is a well-known fact, and there's a lot of industry research that's come out that basically says that apparel brands have seen a 20% decline in their brand value, right? And so if you were to undertake a valuation exercise to sell your brand or do some IP restructuring right now, any valuation that is based on a DCF type approach, a discounted cash flow or an income-based method, is likely to estimate the value of the brand incorrectly, right? So a big question is, do you really think that during a COVID-19 pandemic or any such kind of distress situations, are companies likely to be trying to get rid of their intangibles, right? Again, we've got to think about what third parties are doing and try and compare and contrast with that, okay? Now, one of the big things that we will see, and when I was actually listening to a couple of the global presenters talk on it, they have said that the OECD needs to come out and with additional guidance on specific ways in which these questions should be addressed, right? So a lot of people, because of the change in value, believe that royalty payments should be forgiven, right? So if the company is charging for the royalty, then they say that, for 2020, you don't have to pay us a royalty despite the fact that you are accessing our intangibles. Now, does that make sense? Because at the end of the day, the brand still has value, and that the brand still has value. It just, the sales right now have been depressed because of COVID-19 issues, not because the brand has lost value. If royalties are supposed to be the measure of that brand value, then should you not be continuing to charge the royalty rather than forgive those transactions? Another big issue that companies need to think about is what will happen to the intangible generating functions, right? So in order to do any IP analysis, okay, you have to look at where your DEMP functions are taking place, your development, enhancement, maintenance, protection, and exploitation activities. So the key question we're asking is, because of the movement of people, because they're stranded in their respective home countries, how is there a dilution of the DEMP functions? Should there be new cost plus arrangements being put in place, right? So the IP owner might be in Singapore, but the key CTO, the chief technology officer, or the chief research officer, might actually be a Chinese national who decided to go home to stay with his elderly parents over the COVID-19 period. So he goes home and he, works off the Chinese subsidiaries office. Should his costs be recharged into Singapore on a cost plus basis, such that any IP generating activity that he undertakes while he is physically based in China, okay, still will be attributed back to the IP owning company, which is Singapore, right? It's a very good question. And related to that is also the question of, because he is sitting in an operational unit now, previously he was sitting in a research entity. Now he's sitting in an operational unit, and he's able to see how his intellectual property activities are being looked at and perceived by the operational unit, and he's getting new ideas as well, right? So can the operational unit say that some of the IP generating activity is taking place in China itself and should not be attributable back to Singapore? So all good questions, and I can tell you that as far as royalties are concerned, both IRAS and OECD have not made any mention of it. So, this is not something that we will be talking about today, but we have put in a request. I understand that there are requests to Working Party 6 at OECD to address some of these issues. And the next transaction that we will look at is on financing. And again, as far as financing is concerned, there is very, very little guidance that has come up from OECD or from IRAS, for that matter, on whether any of these transactions, what should companies, related parties do with each other with respect to financing. And I think the biggest issue that we all know and understand is that interest rates are down, right? And if you look at the recent guidance that's come up from IRAS, I'm sure you all know that every beginning of the year in January, IRAS will publish its safe harbor margins, such that if a Singapore company wants to lend to its overseas subsidiaries and the value of the loan is less than 15 million, then IRAS says, here is a number that you can use so that you do not need to undertake any benchmarking analysis. Now, the margins that they have come up with is 2.75%, which is the highest margin increase that we have since IRAS started publishing this data back in 2017. Now, that is very, very interesting fact, right? And we're not sure why that is the case. Either they think that they need a high margin because COVID-19 is causing companies to be less creditworthy, and therefore, lenders should increase the margins. Or alternatively, are they, if you think that, all these margins are applied on top of a prevailing LIBOR or SIBOR, which raises another issue because LIBOR, SIBOR doesn't exist anymore with this new change, that's going to come in by the end of this year. So if you went back and looked at the SIBOR that existed, maybe in September or August of 2020, I think it was about 0.3 or 4%, which means that, effective interest rate that IRAS is expecting is about between 3 and 3.2%. And that's what it has been. That effective interest rate is what is being consistent from 2017 till now. Okay, that IRAS has an expectation that the Singapore lender would receive an interest rate of about 3% on an overall basis, 3 to 3.5%. So maybe that's why that margin has become so high. But when you look at it, does it really make sense? Because is a borrower that is based in Japan, for example, going to be able to pay a 3% interest rate when the Japanese interest rates are all at negative, right? How does that change the dynamic of the related party transaction? And I think the additional question is, because of the situation that companies are in, which apparently is not as bad as it's supposed to be. I'm sure you also, the news alert that came out, I think two weeks ago, that says that 7 in 10 companies in Singapore believe that 2021 is going to be okay, that they're going to be able to survive it, right? So, if there are companies that are having cash, whereas there are other companies that are really, really cash strapped, should these lenders be able to charge a premium for the fact that they have cash readily available and they have managed their books and finances a lot better? Okay. So I think, again, as I mentioned to you earlier, we will not be talking about intercompany financing because nobody has made any guidance on this yet from a COVID-19 perspective. But definitely, I think this is another thing that we may want to look out for, or I would say watch the space for it. Okay. Now let's get into the crux of what today's webinar is supposed to be about, which is really what sort of guidance has been provided by IRAS as well as the OECD. I think I'm going to focus primarily on the IRAS guidelines because there's been a lot of changes, but I will pepper it in with the OECD input as well, because ultimately we need to listen to IRAS, and we have to follow the guidance that they have come up with. And if there are inconsistencies with the global guidance, then that's something that we will have to think about how we manage it. Okay. So this slide basically talks about, I guess it's a compare and contrast between what IRAS is doing versus what OECD is doing. IRAS basically came up with its guidance in September, relatively simple. When I say it's relatively simple, obviously it was meant to be out there to say, guys, here are some of the things that you might want to think about as you approach year end, right? And essentially they said, how are you going to justify that your transactions are okay for COVID-19? That was the first point, under documentation. The second one was on term testing, which basically says that you are allowed to use multiple years of data, which we will talk about in detail later today. And the third one was on advanced pricing arrangements, which I'm not going to discuss in detail because I don't think many of you would have it, but we will talk about it in brief. But if you have a specific question on how to manage your APAs, advanced pricing arrangements, please, do drop us a note, okay? The OECD focus on, IRAS was really around an FAQ basis, right? The OECD came up with its guidance in December 2020, and their focus was really around the comparability analysis. Most of you would have prepared transfer pricing reports. You do need to prepare your benchmarking studies. And the burning question is, in order to justify that my transactions for 2020 is okay, I need to get 2020 data. I will not get 2020 data when I prepare these reports. What am I going to do? So a lot of their issues were around comparability analysis. The next big thing that OECD talked about was, how do I deal with losses? Okay. And how do I deal with COVID-19 specific costs? Right now, I can tell you very clearly right now, both the OECD and the IRAS in passing, OECD in detail, have basically said that in order to allocate any COVID-19 specific costs, you've got to make sure that the cost analysis is consistent with your risk allocation and risk profile, right? So if you end up bearing certain costs, right? So for example, let's go back to the previous example on the trading company. You should not have been bearing inventory risk, but you had to hold on to that inventory and because of that, you had to get extra warehousing space, then the key question is, would you be able to recharge that warehouse cost, that additional warehouse cost that you had to incur because there was a change in the transaction price off to your related party? Because that's exactly what you would have done with a third party, right? So the crux, if you read both the IRAS guidelines and the OECD guidance, right, it keeps on saying the same thing, that you've got to show what you're doing with your related parties, it is consistent with what you're doing with third parties, okay? The third thing that OECD talked about was on the government assistance program. Essentially, right, I mean, the governments have given out huge amounts of money to their respective taxpayers. How should this be dealt with from a transfer pricing perspective? And the last one was on advanced pricing arrangements, right? Now, building on from the guidance that OECD came up with, IRAS on Friday came up with 3 additional questions. The first one was on job support scheme, which I know is a burning question for a lot of you. So we will discuss the question that IRAS has asked and the answer that they have given. The next one is on loss makers. And essentially the question is, as a limited risk distributor, am I allowed to make losses? And the third question is, when I do my benchmarking analysis, can I include loss-making companies, right? Now, I would like to draw your attention to the 2 comments, that I have put at the bottom of the table, which is on paragraph 5 of the OECD transfer pricing guidelines. And if you guys are interested in reading these guidelines, do drop us a note. Actually, they're publicly available, so you can just go and Google OECD transfer pricing guidance. It's a relatively easy read. It's just 31 pages, which is a lot smaller than what OECD typically comes up with. So when I say just, take it with a pinch of salt. And it's written in an FAQ form, right? So if you have a particular question, just go look for that question and see the answer to it. But I think I'd like to draw your attention to paragraph 5 and paragraph 21. And I'm really hoping that tax authorities, not just in Singapore, but across the Asia Pacific region, are going to adhere to this guidance, right? And paragraph 5 basically says that it is important not to lose sight of the objective to find a reasonable estimate of an arm's length outcome, which requires an exercise of judgment on the part of taxpayers and tax administrations. Okay, the fact of the matter is that you are not going to be able to have 2020 data in place when you're doing your 2020 transfer pricing analysis, right? So you are going to do something that may deviate from standard transfer pricing analysis, right? Because at the end of the day, you're trying to tell the best story that you can to show that your transactions are okay. And what OECD has urged is that what we want to try and do is to find a reasonable estimate of an arm's length outcome, right? We don't need to go overboard, and anything that becomes too onerous and difficult to justify, we don't have to do it. So let's keep that at the back of our mind and see whether we are able to justify that our transactions are okay, right? In the same paragraph, they did turn around and say that if you're doing this to avoid paying taxes and doing funny things, then we will take severe action on you. I think the second one, and this is more to the tax administrations, is that tax administrations are encouraged to keep complexities in mind when performing risk assessments, evaluating transfer pricing positions on audits, and considering the support and documentation taxpayers provide that might demonstrate reasonable efforts and care when trying to comply with the arm's length principle. So that's more for the tax administration's perspective, right? So just because a company has made losses, don't necessarily go and look at them from a transfer pricing perspective, right? Take it with a pinch of salt as well, and pray and hope that people are going to be doing the right thing. Okay, so moving on, those of you who've done transfer pricing documentation will know this, and even if you haven't done it, I think it's relatively common that a transfer pricing documentation typically consists of 5 sections. You've got the company overview, industry analysis, functional analysis, transfer pricing policy, and economic analysis. And the stuff in the black, as you can see, are the general things that you need to include when you're trying to prepare a TP report. And what we see is, with respect to steps 2, 3, 4, and 5, IRAS has said that you need to look into that very carefully to ensure that the facts and circumstances for COVID-19 are appropriately represented. Okay. Now, as far as the company overview section is concerned, they did not necessarily talk about it, but if you read between the lines of the OECD, of the IRAS guidance, you can see that they're also talking about it. Okay, now let's take a look at what actually goes into the company overview and where are some of the changes that I have seen with respect to my clients, right? So in the company overview, in general, you're supposed to talk about the general information, your key products and services, key customers, business drivers. And I think it'll be really good for you to put in there how COVID-19 has impacted your operations, right? Now, you will all remember that when you are doing your local file, you've got to talk about, was there, what is your principal business activity? What are some of the products and services that you handle? From a master file perspective, and even for the local file, right, you've got to talk about the supply chain. You've got to talk about key restructuring that took place. So all of this raises very, very interesting questions, right? And I would like to give you two examples. So one is a client of mine who is in the paper packaging business. And obviously he's had a stellar growth, right? With all of the, Deliveroo, Panda, Food Panda type things. And, we have this exercise that we do at home where when we order food and it comes, right, we always, and it's in a brown paper packaging, we always turn it around and see whether it has been manufactured by the client that we represent, right? My kids find it very funny. So he basically figured out that since I am in the paper packaging business, it'll be very easy for me to start a mask business and try and make additional money out of this. And as a result of that, he ended up setting up a separate company to represent his medical business. And he also, worked with the government to make sure that the masks that were being manufactured or were being produced were consistent with what the government wanted, right? So here, there is definitely going to be a significant change in the master file as well as the overall view of the company, right? So the first thing is there is a business restructuring. He set up a new company and we've got to talk about it. Remember that under restructuring, we talk about divestments, acquisitions, establishment of new companies, whether companies go dormant. We've got to talk about all of that. So this is considered to be a key change in your business activity, right? Then you have another company. So the same company also decided to, the same client, the paper packaging company, originally had decided to outsource 90% of their manufacturing activity to China, obviously to try and take advantage of low-cost manufacturing in China. And so they were supposed to import a lot of this paper packaging products. Obviously, with the start of COVID-19, China went into lockdown first, and then each country started to go into lockdown, which when China then reopened and the rest of the global economy was in lockdown, what ended up happening was he realized that he was not able to get his required quantity of paper packaging products, and therefore he has restarted his manufacturing activities in country. Okay. The other big issue that he also started to face was that his shipping costs went up, right? So as a result of all of these things, right? So there were two major changes that took place in this organization. The start of a medical business that was manufacturing masks, and the second one was restart of the manufacturing business in country again, right? So both of these will need to be explained in the company overview section. Let me give you another example. Okay, so we have another client, and this client is in the chemical business. And chemical business is a commodity business, was not making a lot of money. But one of the key things that they were doing was blending, right? So they had people in their organization who were, I'm going to say, who were chemically trained, right? So they were, I wouldn't say that they were chemists, but they knew enough about chemistry to be able to, make the necessary modification to products based on what clients want. Now, these guys decided to set up a antimicrobial coating department. They developed and formulated a product based on the chemicals that they already had. They were actually in the paint business as well. So they managed to be able to do it. They managed to find out a way to apply this, on their lifts and other surfaces. And then they started to sell this product to their related parties. Now, one of their related parties, it turned out that the way that this antimicrobial coating was working did not meet the local government standards, and they needed to make a little bit of a change to the formulation. So essentially, the Singapore company would sell the original antimicrobial coating products to the Malaysian subsidiary, for example. The Malaysian subsidiary will then obtain the formulation, make the necessary tweaks to that formulation, and then create this new product that meets the local requirements, and then be able to use it, right? So as a result of this, the company's profitability for 2020 has been quite good, because obviously you're able to charge an arm and a leg for antimicrobial coating. So in this case, there was no significant restructuring because they did not set up a new business or a subsidiary, but there is a new transaction. There is a new product category. There is a new transaction. There is a new pricing policy that needs to be established as well. Now, one of the big questions that you need to really think about as you prepare this company overview is how long is this pandemic going to last? And obviously nobody knows about that. And the other big thing that you also need to think about is, are these temporary changes, or are they considered to be long-term changes to the operating model, right? So if it's temporary, you may not need to do a detailed write-up of it. But if you think that this is the way you're going to be doing going forward, then you might need to explain that in your documentation. Now, this distinction also will have an impact around how your costs are going to be looked upon by any tax authority. So if it's temporary, you're able to argue for certain costs to be considered to be extraordinary or one-off, and they can be removed from the transfer price calculations. Whereas if you think that this is your new state of business, then they are going to be treated as, normal costs, and they cannot be treated as one-off, right? So you got to be very careful that you get the story right in terms of how you want to argue this. Okay. Moving on, the next one we got to talk about is the industry analysis, right? So this is really important, and what IRAS has asked for is that they want a broad analysis of how the industry has been affected by COVID-19 and the direct impact of COVID-19 on your company. And the second thing that they're asking you to put in there is provide reasons and supporting evidence to justify how your company's profitability has been negatively impacted by COVID-19. Now, thus far, everybody has been talking only about a negative impact, okay? Nobody's really talking about a positive impact because, obviously we're worried, particularly when we are not making money. But I do want to say to you, right, if you guys end up making a lot of money for the COVID-19 period, this also is going to be an anomaly in your operations, right? So in your subsequent years, say 2021, 2022 comes along, they're going to go back and say, hang on a minute, what happened in 2020? What was it that helped you make this huge amount of money or this huge levels of profit or revenues? And why is it you're not able to replicate that going forward, right? So I don't think we should just be focused on the negatives. Even if you're positive, I think that's also something that we need to justify to either argue that this is a one-off or this is here to stay. So with respect to the industry analysis, just talking about the industry is not going to be good enough. Again, we've got clients who are in the shipping industry. And I was talking to one client, and at year end, and I asked him, how has your business been impacted? And I thought shipping would have been really, really badly impacted. And he said, actually, we've had a blockbuster year because yes, the first 6 months was not very good, but subsequently, he said that we had an extremely good year because there was this need for products to be shipped around, and there was not enough supply, and we were not able to clear out of the various ports, and therefore there was a huge demand for our services. Now, I took that learning and spoke to another shipping client, and I said, oh, so you had a stellar year today in 2020, did you not? And he goes, no, we had a really bad year. How do you say that we've had a great year? And I said, oh, my other client in the shipping business had a good year. And he goes, well, he must own his ships, right? We are not owning ships. We are merely a service provider. We are really freight forwarding and logistics and shipping agency. And we have had a really, really bad year for 2020. So the purpose of the story is that just because you get the industry right does not mean that it necessarily explains your results, right? You've got to also talk about where in the industry you are. Why is it certain parts of the industry are doing okay, certain parts are not doing as well, right? And that learning even comes down to the type of products that you are handling, right? So let's take the tire industry, for example. So if you are selling tires, did you make money in 2020 or did you not make money in 2020? Depends on what is your ratio that you have for your tires. If you did car tires 50%, airline tires 50%, obviously you did not sell any airline tires in 2020. You would have sold more car tires in 2020. Was that enough to offset the loss in revenue coming out from airline tires? I don't know, right? What about the, if you did off vehicle tires, off vehicle trucks, is that what they're called? Those big mining trucks that you put tires on them. The demand for those kind of tires were really good as well. So it really depends on what type of products you're trying to sell. And, you've got to really talk about your evidence, okay? Now, a lot of people, back in the middle of 2020 were thinking, oh yeah, COVID-19, really bad year. Okay, the tax authorities have become quite smart, and they have basically said that you can't use COVID-19 as an excuse because the impact is different. And so I thought I'd share with you the Netflix results as well as Singapore Airlines, right, to show how the COVID-19 has impacted these two companies so badly. And Netflix, as you all would have seen, they have increased their subscriber base to more than 200 million subscribers. A fair amount of the growth is coming out from Asia, and they think that Asia is still, there's a lot more potential to growth because a lot of people still hold on to traditional TV, right? And rather than just move away into a, something like this, like a Netflix or any of the other type of products like Amazon Prime or Disney or anything like that, okay? So just keep in mind that you've just got to be able to justify where you are and what you're doing. Okay, now let's move on to the third section of the TP report, which is going to be on the function, asset, and risk analysis. And here, there is a fair amount that we actually need to get through and talk about, right? I think with respect to the functional analysis, the first question that IRAS is actually asking you is, got to tell me who is making these decisions as far as COVID-19 is concerned, right? Let's go back to the guidance that IRAS gave on risk analysis, right? They said, are you able to show that you have the capability and the authority to take on those risks? If you say that I bear these risks, and you got nobody in the company taking on, making the decisions associated with those risks, then technically you should not be bearing those risks. That is what they used to say, and that's what the fifth transparency guidelines also talks about. Now, when you look at the first question, so they're really saying who is making these decisions, and are you in control of these decisions? And the second one is, has the functional analysis of your company and the related parties before and after COVID-19, has there been any change, right? So with respect to that, if you look to the right-hand side, how are you going to apply these the concepts, right? So the first thing you have to do, at least from a qualitative perspective, identify where the key decision makers are from a risk management perspective. Where do they sit? If they went back home, right, because they wanted to be close to their family, what does that mean? Who ended up bearing their costs? Where did they undertake these risks from, right? Did the head office give you any instructions with respect to COVID-19, or did you end up making your own decisions? Okay, let me give you an example, right? You decide that you want to cut your losses and therefore you want to exit a product segment. right? Did you need to go back and get permission from your head office, or were you able to make that decision on your own? And if you had to go back and get permission from the head office, did they say yes or no, right? So you might have wanted to do it. Head office says, no, you cannot do it, which means you continue to be in this space. This means that you are not making these decisions as far as COVID-19 is concerned, right? And therefore, your transfer pricing documentation should reflect that, right? The next one is, are there any changes in your function asset risk profile? Let's go back to your manufacturing and distribution example. Manufacturer is supposed to manufacture, and he's going to sell the products to the distributor. And the onus is on distributor to manage all of that inventory, right? Manufacturer is not able to sell the products, therefore he ends up holding on to all of this inventory. And therefore he starts having that inventory management function, and he starts taking on the inventory risk, right? Should we start seeing a change in the function, asset, and risk profile? And should we start seeing a change in the transfer prices that are charged? Yes, that is definitely the case, okay? So the next question that you got to think about is, when did these changes happen? Were they temporary or were they permanent, right? So the changes might have happened just during the circuit breaker period, right? April and May, the changes happened. Start June, it went through. In this case, you do not need to make adjustments to your transfer price because that is a momentary change, right? However, if this happened the entire year, then you might really want to think about, am I going to be compensating that manufacturer for the risk that he is bearing, because technically that inventory risk should not have been with him, right? Now, given these changes, is there a revision to your transfer price? Okay, if there is no revision to your transfer price, then are we still consistent with the arm's length standard, right? And the next question that they ask is, can a limited risk entity make losses? We will come back to that question later, because as I mentioned to you, IRAS gives explicit guidance on Friday on it. And finally, I think we need to start thinking about what risk exactly is there, right? So COVID-19 itself is a hazard risk, right? So it is a overarching risk that exists, which can then impact your marketplace risk or your market risk, which means that the products that you're selling could suffer a decline, okay? It could impact operational risks because your supply chain can be disrupted, and it could also impact your financial risks, right? Because borrowing is going to be difficult, working capital financing is going to be difficult, right? So how are you reflecting these risks in your transfer pricing documentation, and how these actually changed over time, right? So let's take a look at the IRAS questionnaire, the question that they asked. And the question is, can an LRD make losses? So the question that has been asked of IRAS is, my company is a limited risk distributor for the group's products. The group suffered substantial losses in FY 2020 due to the COVID-19 impact. Is my company allowed to share the losses of the group in FY 2020, right? So honestly, if you look at OECD, if you look at IRAS guidelines, they both say that it really depends on the specific facts and circumstances, and do we actually have a situation where third parties also end up making losses, right? So what IRAS has said is that, and the answer that they give is this, okay? For example, there is a significant decline in demand due to COVID-19, resulting in losses for the group. If the analysis of the allocation of risks following the guidance shows that your company assumes some market risk, but not risk of inventory obsolescence at arm's length, your company may incur a loss associated with the playing out of the market risk. This is subject to reliable evidence showing that independent distributors undertaking a comparable transaction would have similarly incurred losses under comparable circumstances. However, your company should not bear the portion of the risk associated with the playing out of the inventory risk. Okay, now then it says that if the analysis shows that your company does not assume any market risk, inventory risk, or any other specific type of risk, your company should not bear the losses. Okay, so lots of words. So let me summarize. I think the gist of it is, if you are supposed to be a limited risk distributor or no risk distributor, right? So your TP documentation has said, I don't bear market risk, I don't bear inventory risk, I don't bear credit risk, I don't bear product liability risk, I don't bear foreign exchange risk, then you cannot book a loss for 2020. Okay, now I think that is very, very clear. But my struggle is, if you look at the second bullet where it says that you got to show that independent distributors are undertaking a comparable transaction and they would have incurred losses. Now, you do not have a concept of limited risk distributor with independent companies. So I think that is a difficulty, and that's the difficulty that we've always had with respect to transfer pricing. I think the second issue that I have is also that where it says that you can bear the portion of losses that are related to marketplace risk, but you cannot bear the losses associated with inventory risk. Realistically, are we sophisticated enough to be able to look at our P&Ls and say, this is the level of loss that came about because of the marketplace risk, and this is the level of loss that came about because of the inventory risk? Are we that sophisticated? I think that's a fundamental question. And I think the onus is on the taxpayer to be able to demonstrate that. And with the way in which benchmarks are being done and the aggregation of financial data that takes place, I think this is actually very, very difficult. Now, IRAS's guidance that basically says that if you do not bear the risk, you should not be making losses, is a departure from the OECD, because the OECD basically says that what we've always talked about is simple or low risk entities. We have never said that it is a zero risk entity. So, and if you look at the OECD transfer pricing guidelines, it basically says that as a simple or low risk entity, these entities are not expected to generate losses for a long period of time. So OECD is saying that if it's for a short period of time, then it's okay. It's possible that LRDs are allowed to make their losses. Now that's very interesting, because if you contrast IRAS against OECD, obviously, let's take Indonesia, for example. Indonesia or Malaysia will be relying on OECD guidance, where Singapore is going to be relying on the Singapore guidance, where Singapore guidance basically says that if you do not bear risk, you cannot. If you do not bear the risks, you should not make any losses. I think the other question here is also around what your previous documentation said, right? So one of the things that we've started doing for the past couple of years is that even though you're supposed to be and we started doing this since we started dealing with the global financial crisis, since we started realizing that it's possible that you end up making losses because of external factors, we've said that even though you may not bear direct market risk, you do end up bearing indirect market risk because of there's a overall decline in the economy. There could be a natural calamity that's going to cause problems and things like that. So I think that's something that we've started doing. But if your traditional documentation is said, I'm a zero risk entity, and that's what you have been saying, then the view from IRAS is that you should not be making any losses. Okay. Let's move on to the transfer pricing policy. I think the key question is, can transfer prices be negotiated? And I think here, I think the main question here is, there's no specific guidance that's coming out from IRAS on this one. But if you look at the OECD transfer pricing guidelines, it basically says that if the distributor, that there can be situations where transfer prices should be renegotiated. And the example that they have is that distributor X purchases products from company Y and sells to third parties in country X. Assume that a major customer of X does not pay for the products purchased within the 30-day term. Therefore, the X has cash flow issues, and X should have cash flow issues because he bears credit risk. Now, the key question is, can X renegotiate his payment terms with Y? Okay, and this was actually a poll question. So if we can have the rest of the options. So the options are yes, no, or not sure. So could you please submit your responses so that we can go through it? Okay, do we have any results yet? Okay, so why don't we look at the results later once I hear back from my team. But in the meantime, the guidance from OECD basically says that what would third parties have done? Okay, if third parties would have, renegotiated the prices, and if you are confident that they would have done it, then that's fine. The OECD also made a very interesting comment in its guidelines, which basically says that, you don't need to do your comparables analysis on an annual basis. If you ended up into a long-term arrangement, so let's assume that you entered into this transaction in 2018 and it ends in 2022 or 2021, right? And when you entered into the transaction, you undertook your relevant analysis that helped you justify what your transfer price should be. Then because you are not allowed to get out of this contract because it's in line with like a third party, what it basically says that you can use the analysis that you did at the beginning of the time when you entered into the contract as the basis of the analysis to show that this transaction has been impacted. Okay, and to support the arm's length nature of the transaction, right? So I think that is quite interesting because that's not something that we are starting to see from the from third parties, sorry, that's not something that we see from our tax authorities, right? I think the view is that they think that you should be redoing your transactions every year. But there is some merit to this viewpoint that the IRAS, that the OECD has come up with, right? I mean, just take the situation of housing loans in Singapore, right? I mean, interest rates have gone down now, and yet we are not allowed to renegotiate our loan packages, right? If you are in your 3-year lock-in period, you will not be able to renegotiate the terms, even though there is a downward adjustment on the interest rates. Right, so it is possible that you could evoke that sort of argument and say that, at the time when I entered into the transaction, this is what I thought the pricing should be, and I'm continuing to apply that pricing irrespective of the changes in the marketplace because my related parties and we have committed to hold on to this pricing structure. Okay, now just on the polling issue, I think 80% actually ended up saying yes, that you can renegotiate your payment terms on a temporary basis. That's fine. Now then if you go back and you look at your functional analysis back here, doesn't that mean that you're starting to see a change in your risk profile, right? So we moved our risks from the from X or Y, this distributor to the supplier. We've moved that credit risk over to them. And does that mean that there should be a change in the transfer price there too, right? Just because I renegotiate my payment terms. Okay, let's move on to the next slide, which is on determining the Singapore taxpayers' results. And I think this is actually the most important section that you guys are going to be interested in, which is around how are you going to justify if you've ended up making a less than normal profit, right? And let's look at what OECD says. Let's look at what IRAS says as well. So the guidance from IRAS basically says that you need to do a comparison of the budgeted and the actual results of the profit and loss analysis of the company, providing explanation and evidence to support the variances. Now, this is really funny. I was talking to a couple of clients and they said that they do not do budgets. And this is something that I have, even when we started doing these sessions back last year, I did say, let's start keeping our budgets in place so that we are able to show that this is what we were thinking that we were going to achieve. But we ended up achieving here because of COVID-19, right? So that's something we need to really put out there. I think it's a very good point, to do the budgets, but I think the question is also going to be, what is the robustness of those budgets? And is IRAS going to believe those budgets, or are they going to turn around and say, hang on a minute, you did these budgets in January 2021 or February 2021 after you listened to Saumia's seminar, right? How are you going to show that these budgets existed at the time when you started doing the transaction? I think it's all good questions. So how are you going to, what are some of the things that we need to put in place? I think the first one is, has your revenue changed? Why are those changes coming about from? Was there a change in the sales channel? You moved from, mainstream to online. Was there a change between pre-COVID, during COVID, and post-COVID, or pre-CB, during CB, post-CB, because it can't be pre and post-COVID, we're still in COVID. So I think that's one thing. I think the next one is, was there an increase in costs? If so, who should bear these costs, and should they be allocated to the related parties, right? And I think, we've only talked about increase in costs, and a lot of people will think that, oh my God, let me go and treat it as non-operating, but can they be treated as non-operating? Number one. Number two, can you recharge these costs over to your related party? What about the benefits that you got, right? Like the loss, the reduction in travel and entertainment related expenses, right? I mean, nobody went out, nobody flew around, and a lot of companies ended up making money because of that precise reason. Okay. The next thing that we need to also think about is, trying to produce interim financial statements to show how circuit breaker has impacted the results, or lockdown has impacted those results, right? So what happened before? So are you making monthly analysis? And, one of my clients does do them, and it's a very simple operation, and therefore it's easy for her to do, but she actually puts out the, on a monthly basis, she tracks her revenues, and we could really see that in April, May, and June, there was a complete drop off of the revenue. Okay. And she's in the commodity space, so she's already committed to buying her products, and therefore there was a significant loss. And then we start the revenues come back up, right? And that's exactly what happened with oil prices. I mean, last year, in a month from now, I think you will see, last year you would have seen negative oil prices, and today your Brent prices are about $52, $53, right? And the expectation is that it's going to hit $60. So, all of this needs to be looked at and explained. But at the same time, right, I mean, there is a lot that is also not impacted by COVID-19 as well, right? I mean, the entire turmoil that we have seen this past 2 weeks, right, with the Robin Hood issue, the price of silver. I mean, all of this is going to have an impact on our operations as well, right? So that's another thing that we need to keep in mind. So I think that there are a couple of things that you want to look at, right? So reduced demand due to restriction on travel and immigration, as well as production and sales suspension, reduction due to plant shutdowns. How have all these impacted you? Put in some specific information around incremental or exceptional costs that we've talked about. Any macroeconomic information, what did the country GDP do? Is your drop in revenue consistent with the drop in GDP results and stuff like that? I mean, if you look at the OECD, they're also talking about statistical analysis, regression analysis. And when I was reading that, I was just thinking, okay, that's way too much work, okay, to prepare. Going back and thinking about when OECD says that all you needed to do was a reasonable estimation or reasonable effort to show that you're meeting Armstrong standard. Doing a regression analysis and other complex statistical models does not seem to suggest a reasonable effort, to be honest. And, it's like OECD talks from both sides of the same coin. I think the next one is also around any internal budgeting and forecasted data that you might have. That would also be good. Okay. Could we have the next polling question now, please, just so that we can see? I think the question is, how has COVID-19 financially impacted your operations, right? So did we see a growth in revenues or a decrease in revenues, right? And we will look at what that is, and let me just look at it. Give me a second. Thus far, I've only got 2 responses. Now we're starting to see more. Okay. I'll just give it 2 minutes. Right. Okay. So we've had about a half set of employees, half of the responses coming through, and I think 77% have said that there is actually a decline in revenues. I think 2 people, out of a sample of 30, actually said that there was no change in revenues, which is quite interesting. Okay, so let's move on and let's look at what exactly. Let's now talk about the government assistance, right? So the key question here is, how are you going to treat government assistance? And rather than talking a lot about this slide, let me just go and discuss the question, which is on everybody's head, I'm sure, because I'll tell you that as much as we did a firm-wide shutdown for Christmas, and I at least had 3 calls from clients saying, what do I do with my JSS? Can I offset it in my cost base, right? And I had to give them some guidance. And at that point of time, IRAS's comments were not out, but it's come out now. So let's take a look at it. So the question is, my company received government assistance, i.e. the job support scheme. How should my company treat the benefits from the government assistance for transfer purposes, right? And IRAS and the OECD, both of them have said that whether or not JSS is economically relevant and has a direct impact on the related party transaction, it really depends on how independent parties would have treated it in comparable transactions. And to be honest, independent parties would not have passed on the benefit of JSS to any of their third parties. So the IRAS has come up with a further example. It says Singapore company is a contract manufacturer, has gross wages of $10,000 and other operating expenses of $9,000, receives a JSS payout of $5,000. An unrelated Singapore company in the similar industry, they also receive JSS, and they, when you look at their financial data, you determine that the markup that they are earning is 25% on costs. And what IRAS says is that in the absence of detailed information on whether the unrelated Singapore manufacturing company would have passed on the benefits of the JSS payouts to its customers, Singapore company can take the view that the unrelated manufacturing company would retain the benefits from the government assistance, right? So the first thing you're supposed to do is figure out whether they were passed on to the customer, right? And it's extremely difficult to do so because you do not know what was the price in 2019 and what's the price in 2020, right? So did we reduce our price and therefore pass on the JSS? Or was it really competitive and therefore we reduced our price? We don't know that, right? So IRAS saying, let's be conservative and let's assume that the JSS is not passed on, and therefore what you should be doing is doing a computation based on this. Just as an aside, the JSS is going to be non-taxable in your returns as well, right? So the $5,000 is kept on its side. You've got $19,000 of cost, 25% markup on the $19,000. So your transfer price, which is the price that you're going to charge to a related party, is going to be $23,750. Right? Now, let's assume that you guys end up adjusting for JSS because you didn't get this FAQ in time. So essentially, rather than booking your cost at 19, you book your cost at 14, which means, and you still apply the 25% markup, which means that your markup is $3,500 and your transfer price is actually $17,500. So you charge $17,500 to your related party. Now, what IRAS is likely to do, again, we do not know this, but what we think that they're going to do is they will come back and look at what is the effective markup. So this $3,500 as compared to your original cost base of $19,000, and that markup is actually 18%, and they are likely to see whether this 18% is in the arm's length range or not in the arm's length range, right? Now, if it is not in the arm's length range, unfortunately, there is going to be additional tax penalties that will be applied on it, okay? I think, guys, if you still have ability to change your computations, then please make sure that you're not offsetting the JSS. The other way in which you could do it is go ahead and close your accounts in this way, but in your tax return, you deem that amount back and be subject to tax, but obviously that's also going to lead to double taxation and other issues. I think there is nationalism at stake. I had a very upsetting conversation with a client who actually received a lot of money in JSS and decided to offset it. So did the computation like this. And when you actually calculated the effective markup was 1.3%, right? Which means that the entire benefit of the JSS has been passed off to their related party, which is actually the US, right? I'm again going to say, right, if you are, whatever you do, your related parties are not passing those benefits to you. So there's no reason why you should be passing those benefits to your related parties. Okay? Okay, so let's move on to figuring out how you're going to support your transaction. I'm sorry we're running a little bit over in time, but I'll try and move this along, and I think we should be able to do that. So when you do your transfer pricing analysis, you know that the way in which you're supposed to do it is you look at your single year results and you compare it against your multiple year analysis for your comparable companies, right? So this would be a typical way in which we would do our transfer pricing analysis. So FY 2018, you have an operating margin of 4%. That is compared against a 3-year average of your comparable companies coming from 2015 to 2017, for example. And we say the 4% is in line, 5% is in line. And here you have 2020, your results are negative 6.67%. Whereas when you do your benchmarking using 2017 to 2019 data, because 2020 data is not available right now, those results come up at 2.5%, right? So technically, if you were to do a single year testing result, like the way you traditionally do it, compare the negative 6.67% to your 2.5%, it essentially means that there is going to be a profit that you have to pay additional taxes on adjustment of 1.375 million, going from a minus 1 million to a positive 375,000, because IRAS will always make the adjustment from the 6.67%, which is what you have earned, to the point of the median. So you go from minus 6.67 to a positive 2.5%, which is what you're getting. Okay. Now, what essentially IRAS is saying is, rather than doing it on a single year basis, I will encourage you, I allow you, okay, to do it on a multiple year basis. So don't compare the 2020 results, but compare the 2018 to 2020 for the tested party with the 2018 to or 2017 to 2019 for the comparables, and hopefully the profitability of the prior years will offset the loss that you're booking in 2020. Okay, now, so in this example, okay, the number that you have ended up with is 2.14%. And this 2.14% is in line with this interquartile range, and therefore no adjustment will need to be made, which essentially means that you are allowed to book a loss in 2020, and you are allowed to submit your return based on a minus 6.67%. Okay, so this is a great benefit to you all. Now, where does it not work? Let's take a second situation where you have, pretty much exactly the same numbers, but I have changed my benchmarking data, right? I've made my medians to be a lot higher. So essentially what you have is you have to go from a minus 6.67% to actually a 4%. So when you go to a 4%, okay, what it really means is that the single year data will need to be adjusted. You will no longer be at a minus 6.67%, but you will have to be at 2% on a single year basis, which then will make your overall 3-year results into a 4%. Okay, so in this case, rather than paying a $1.6 million adjustment, you are only paying a $1.3 million adjustment. So in this case, you do have to make an adjustment, whereas in this case, you do not have to make an adjustment. So this is IRAS's preferred approach with respect to you justifying your transactions. Okay, now what are some of the difficulties that we are going to face here? Okay, I think the first one, which is going to be very obvious, is that the 2020 data is not available yet when you're doing your 2020 TP report. So how long are you going to be waiting for it? IRAS hasn't come back and said what you should do with these kind of questions. What they are still suggesting is look at your prior 3-year data and see where you're going to be ending up at. Okay, I think the next question is, if you were doing on a 3-year cycle, right? Remember, you would have done your TP report in 2018, you've done your benchmarking, you use these results and you roll them forward to 2019, you use the same thing, roll them forward to 2020. Now, the big question is, are these companies, are they still relevant comparables, or did they have a substantial shock in their businesses for 2020, which is the year you're looking at, even though the data you're going to be looking at is from 2017 to 2019, that makes them not comparable? I think that's another big question as well. Okay, what has OECD said about all of this? I think the first one we've talked about, they have talked about the budgeted financial information. Can that be used to support the arm's length price? The answer is yes. How do I deal with the lack of information and data? They've really not come up and said anything on that point yet. They've only said use your best adjustment, try and tell the story as best as you can. Can data from other crises be used to support price setting? The answer is no. Okay, so a lot of people are talking about all the great analysis that we can do, but OECD has turned around and said that the GFC was a very different crisis compared to the pandemic, and the impact on economic impact is very different. This is not going to be possible. The next question they said is, can loss-making comparables be used? And OECD says yes, it is possible to use loss-making comparables, particularly if we can ascertain that the accurate delineation of their transactions indicates that the companies are actually robust and correct, right? Now, that is a change or a divergence from what IRAS is saying. What IRAS has said is this. So the question is, my company has been severely affected by COVID-19. Can I include loss-making companies in my benchmarking study to help determine the arm's length remuneration of the transactions? And IRAS has said, honestly, they've said no. Okay, I mean, all of that, when you read to the end of it, the answer is no. What they have said is we would prefer that you use a single year data approach rather than a multiple year data approach rather than single year. And what they have said is that IRAS is of the view that excluding the following comparables would eliminate persistently loss-making independent parties, i.e. entities which sustain losses over a period of time for reasons other than COVID-19. And therefore, that is what we need to be looking at. And it says that, suffer losses. A company that satisfies the comparability criteria suffers losses in the years affected by COVID-19, but does not suffer sustained losses over a period of time, can be included in your benchmarking study. But I think you've got to really look at it. So if we are doing the 2020 reports, and we're going to be looking at 17 to 19 data, you cannot include loss-making companies because that's contrary to what IRAS is asking for. Okay, now obviously IRAS will have to look at it, will have to monitor and review this guidance, and that's something that we hope to see later part of this year. Okay, now let's move on to the next section on APAs. Like I mentioned to you, I'm not going to really discuss it, but I think the strategy that they're going to take as far as an APA is concerned really depends on where you are in the APA process. So if it's a new APA and there is no impact from COVID-19, then they are not going to worry about it. But if there is an impact from COVID-19 because you're changing your business operations, or you're in a loss, or you do not know how to show that your transactions are okay, they're saying wait and watch. Okay, if the APA is currently being decided by the taxpayer authorities, then if there is no impact of COVID-19, then there is nothing that we need to worry about. But if it has been impacted, then you have to let IRAS know, and then IRAS will look at it and think about what they are going to do and whether there should be any changes that should be done. I mean, we had a situation where we were trying to go in for an APA. We did do our pre-filing meeting, and then COVID-19 hit. So we put a pause on it, and IRAS has supported us and said, okay, once you figure out what is the true impact of COVID-19, come back to us, and then we can think about what we need to do. Okay, and then the next one is on the existing APA. So you've already concluded your APA. Now you are in monitoring phase. Then if there is no issue for COVID-19, then there's nothing you need to do. But if you think that your critical assumptions have been breached, then you've got to let IRAS know. Then IRAS will figure out what they're going to do as far as you're concerned. Okay, I think that's all we had. I think we have 5 minutes. So before that, here are some key takeaways. I think the basic one I want to say is that further guidance is going to be expected from IRAS. And I think that documentation is actually really, really important. And one of the things that you all might know about is the qualifying past TP documentation, which means that what you had in 2019 can be used for 2020 if you meet certain conditions. So you don't need to redo your entire TP analysis. But I think because of the changes in the business model, changes in the transacting party, a lot of people are worried that they may not meet the qualifications for qualifying past TP documentation. But this is something that IRAS is going to come back and give comments on to us. Okay. We did receive a couple of questions beforehand itself, but before I go through those questions, I just want to let you know that you can subscribe to our tax and transfer pricing newsletter. It's complimentary, and there'll be a pop-up that you'll come up. There it is, that you can just go and click on it, and you will hear regular updates from us. Okay. Now, if you have any questions, I know we've got 5 minutes. If you have any questions, please feel free to put them in. But if you do not have any questions, or you want to think about what you've heard, feel free to contact me or the Crow team. That's I think you should be able to see my contact details. Just feel free to drop me a note, and I'd be happy to assist you in any way that I can. I think I want to talk about 2 questions that I got. I hope you all can see this. So the first one is, I think the question disappeared from me. Oh, hang on, let me pull up my paper. Okay, sorry. Is it possible to claim the lockdown month's rental and utility expenses as non-operating in nature? For those who would have managed to get a rental waiver, the operating expenses would be reduced to that extent. Okay, so I think it's a very good question. And I think that some of the things that I've just explained to you might help answer that, right? Now, if you are continuing to, have that, and those expenses are still going to be there, I don't know if we can treat it as non-operating. I mean, let me come up with another way for you. Let's assume that you have 2 stores and you shut one down because there is no traffic in that store, and you keep one alive, right? And now if that is the case, then obviously the one that you shut down, you can definitely, and you're not able to get out of the contract, let's assume that, then you can go ahead and take it out, right? I think it might be hard to argue that it is going to be considered to be non-operating, because even after lockdown happens, right, when we reopen, even then the footfall was very, very low, okay? But you still needed to keep that space alive, even though you did not have people visiting it in order to store your merchandise, your inventory, and stuff like that. So if that is the case, I think it might be difficult to argue that it's going to be considered to be non-operating. But what I might suggest is try and argue the case if that's possible. Okay. Okay. So my next question that I have is it's on retail question. Suppose there is an entity which predominantly did store sales, right? So, and it says luxury watch company, right? So let's take a Sincere watch or a Frank Mueller, or honestly go to Marina Bay Sands, right? Everything is really empty. But due to COVID-19, it was required to shut its stores and go online, which it never did before. What TP implications would arise from this shift in the mode of sales, right? Again, it's a very good question. And I would ask you to go back and look at the company overview slide that we talked about, right? So this is definitely a change in your business model. I think then it raises a lot of questions, right? Because your entire supply chain has changed. Likely all of your pricing policies would also be changed, right? So yes, you buying your watches from your related party, assuming that's what it is, that might still stay the same. The pricing structure might stay the same, but now you might end up having a server somewhere. You might have a company that offers that server space for you. You might need to set up a digital presence, and you might need somebody to manage that for you. So all of that leads to additional related party transactions potentially. And even if it is not a related party transaction, that could also lead to additional costs for you, right? So I do believe that even though your main transaction, which is potentially the purchase of watches from your related parties, stays the same, there might be other transfer pricing related party transactions and additional ways in which you've got to rewrite your transfer pricing documentation, right? And I think it also really will ask, whether there is a change in your function, asset, and risk profile. Your function analysis is going to change, right? You no longer employ sales staff on the ground. You don't employ people anymore because everything is online. So how does all of that happen? Okay. I hope you all found that interesting. We are at 4 p.m. and therefore, I'm happy to hang around it if you have any more questions. But